Alright, Alibaba recently just reported their Q2 earnings on November the 17th. So I had some time during the weekends to really sit down and look through all the numbers reported and the commentaries guided by the management team. So let's cut to the chase. All of you know that I have a huge Alibaba position. I think I don't have to reiterate the point. This journey thus far has been pretty excruciating. It's at least close to 2 years now. And I think I just wanted to provide some ground context before we actually dive deep into the video itself. So specifically, I was essentially just Googling around and understanding the context of China's e-commerce business. Because we understand that at least on the online space, proponents or at least bears of Alibaba have been saying that, hey, Alibaba's core commerce business, which is situated in China, if you were to strip away all other business segments of Alibaba, if I don't care about their international commerce, their cloud computing, etc., etc., I just wanted to look at the core commerce business in China. And I don't want to just look at Alibaba alone. I want to look at the market. And I came across this very interesting graph from Statista. So for Statista specifically, if you were to look at it, I believe we all know that the pandemic happened in 2020 and China did a pretty good job in terms of combating 2020. So the lockdowns were effective until it isn't. So this graph actually depicts the total revenue being generated by e-commerce activities in China. So of course, it depends on how much you trust the source itself. So I think if you have to observe, we have to compare 2019 to 2021, this was essentially an explosion to the upside. I think the CAGR is at least 8 to 10%. But in 2022, of course, 2022 haven't ended, so this is probably on an expected or an assumption basis, and they projected out into 2027. 2022 actually saw a pretty big dive downwards in terms of revenue being generated by the entire e-commerce activities in China. So this is at least a down of around 15%, give or take. And if you were to really superimpose this entire idea of e-commerce activities slowing down in China, I think you can draw a relatively good picture. So I think for greater visibility, we should and we must look at Alibaba's competitors in China, which is namely Jingdong and Pinduoduo. So unfortunately, ByteDance, which is the parent company of TikTok, is currently also extremely aggressive in this entire e-commerce space. But they are a private company, so we don't really have access to their numbers. But that said, I think we can still kind of triangulate to really have a sense and kind of have a vibe check in terms of the entire e-commerce activities in China today, which then segues into how I'm going to break down this entire video series around Alibaba's earnings. So I'm expecting this to be a 3-part series. So in the first part, I think I'll go through the earnings presentation itself and also the earnings document. And on the second part, we'll go through the transcript when analysts ask tough questions to the management team and essentially the guidance and the outlook of the business itself. And on the third part, JD.com actually just released their results. So I will superimpose Alibaba's results with JD's results and really to have a better gauge of the entire e-commerce industry in China today. So if you are excited for what's to come, remember to help smash the like button. And yes, sit back, sip on your coffee and just enjoy the show. This is crazy. Weibo just extended their latest sign-up reward and it has never been better. So you can get up to $150 cash voucher if you fund and trade your Weibo account today. So all you have to do is to sign up for a new account with the link below and deposit at least 2,000 Singapore dollars and execute one buy trade for a stock or ETF and one option. And that's a whooping 10.5% ROI on your initial capital. So for those of you who have been sitting on the sidelines for some time now, I think this is the sign to get yourself motivated. So Weibo prides itself on zero commission trading. So let's stop paying commissions and use them to buy more Alibaba. So if you need another reason to sign up for Weibo today, they are also giving out attractive referral rewards if you get your friends to sign up using your own referral code. But of course, you should do so with mine first. Wink wink. Don't let this 10.5% ROI slip away so easily. Link will be in the description. Thank you Weibo for sponsoring this video. So diving into the slide deck itself, Alibaba always provides us with the financial highlights of their business because I think people tend to forget that Alibaba is a conglomerate today. At a $200 billion valuation, it doesn't do only one thing. And they always do a segmented breakdown. And of course, in the later part of this video, we will take a deeper dive. But just some high-level understanding in terms of how I annotate most of my diagrams and how I do my highlights. I think for red color, it's self-explanatory, means that it's kind of a red flag and you probably want to put in more attention to those details. Yellow color, I'm probably more neutral or sometimes even more positive. And for positives, I'll use green, like really positive, I'll use the green highlight. But evidently, I haven't been using a lot of greens in this earnings report. Not saying that it's not a good report, but I will make that conclusion at the end of this 3-part series. But I'm just saying that to me, in order to warrant a green highlight, it has to be spectacular. And evidently, it hasn't been extremely spectacular. But that's not the point. Now, going to total revenue, I think if you to compare to the big tech conglomerates, for those of you who don't know, because I've been monitoring Tencent as well, because I'm a Tencent shareholder, Tencent has been experiencing some sort of growth deterioration. It has been posting negative year-on-year results for at least a few quarters now. And I think Alibaba kind of did missed revenue estimates from analysts. I think analysts was expecting a 4% year-on-year, but 3%, I think it's a slight miss. It isn't really a very big problem. I think a bigger issue is when we dive into the revenue segments or the business segments itself. China commerce is a problem and cloud computing is a problem. I think surprising us on the upside is really the local consumer service and Cainiao, which is their logistics network. And we'll get to see what's actually going on behind the scenes as they provide their commentaries on the different business segments. Now, looking at income from operations, this 12%, it's not really a very good indicator, because I think just to provide you with a very quick snapshot, because nobody really knows what this 12% margin actually means. I know this Excel might look a little bit overwhelming, but just to orientate you with a little, I actually brought in or actually just compounded the numbers from at least the last 12 quarters of Alibaba, starting from Q1 of 2019, which is June of 2019. And I think the only utility of this Excel is really to provide you with a snapshot and a brief overview of how Alibaba has transformed and evolved over the years. And by evolving, I don't mean a positive connotation. They can evolve to the downside as well. And you can see that under this consolidation tab, it's always on the rightmost column for all the years. Actually, Alibaba's operating margin has been on the downtrend. So they started off in 2019 pretty healthy, usually above 20%. So you can see that Q1 is 21%, Q3 is 24%. More often than not in Q4, their operating margin actually collapsed to the downside. So I did kind of color code it. More than 20% is green and less than 10% is red. So moving into 2020, similar trend, 20%, and then it starts slowly showing signs of weakness. And I think in 2021, it was probably the trough for Alibaba's margins. You can see that Q1 was 15% and then it just plummeted to 7.5, 2.9 and even 8.2%. So I think moving into the new year, which is the financial year 2022, they've actually held margin constant at 12%. And this is kind of in line with their broader efforts of being more cost efficient and optimizing their operational efficiency. So for this 12% margin, I think investors kind of gain a little bit more confidence when they really look at, based on 2021 figures, these are essentially atrocious numbers. So at least for now, they're holding steady. I'm not saying it's a good or bad thing, I think it's up for interpretation. Secondly, I think if you look at share-based compensation, it's kind of on the downtrend as well. And it has been a pretty big issue for many of the tech companies because it's kind of a way to lock employees, especially all these high-value employees. It's a necessary evil. But on one hand, if Alibaba has been pretty aggressive, or at least has been providing aggressive guidance in terms of buybacks, but if on the other hand, if you have been constantly issuing out a lot of shares, it kind of negates each other, but it seems like it's trending in the right direction for now. Last but not least, I think this diluted earnings per share in the negative has caused a lot of investors some panic. But that said, it's essentially just an investment write-down. Pretty similar to Tencent and also Berkshire Hathaway, for those of you who know their business model. Because they have to mark to market many of their investment deals. So some of them, they're invested in publicly traded companies. And you know that the public markets hasn't been very kind to many of these equity positions. So which is why they have to mark in the losses. So at least for me, I don't really place too much attention in terms of the earnings per share or net income. Instead, I think we should focus a little bit more in terms of free cash flow and also the operating margins of the individual business segments itself. Now, moving on to the next part, which is the cost of revenue and the operating expenses. You can see that one tick means good, double tick, fantastic. So in terms of cost of revenue, they kind of hold constant, even though it's not on a decreasing trend, but at least it's held constant for the three main categories. And at least for sales and marketing, you can see that it's essentially a leg down. and they have been pretty tight in terms of their cost controls. So it's in line with what management, or at least how Toby, which is the CFO, is guiding how Alibaba is trying to lean down their operations. Now, moving on to the income statement, similarly, this 42 billion renminbi is the write-down in terms of investment, and this share-based compensation in the last quarter is around $1 billion USD. So the significance of this, we will discuss it a little later on, but this is a negative, by the way, in case you don't know what I'm alluding to. And I think the last part, this really caught my attention. There's this expense called equity settled donation expense. And when I first looked at it, I was scratching my head. I didn't understand what was going on. So sure, you might argue that, hey, 500 million renminbi is not a lot of money. So I made a remark saying that, is this a CCP donation? But then we know that Alibaba and Tencent specifically has already pledged a separate $15 billion fund to the Chinese government in terms of trying to build infrastructure and trying to help build some technical expertise for the population. So there was this brief explanation in the document itself. I didn't really buy the argument. I think it was some sort of charitable donations. But I think it's a very important point to kind of take note, because we don't want it to keep ballooning from 500 million and then later, what if it balloons to 5 billion? Who knows what's going to happen? But I thought it was a pretty interesting discussion and a pretty interesting discovery from this entire report. So do feel free to leave in the comments below. Do you think this is a CCP donation or something of that sort? So looking at the free cash flow profile of Alibaba, it finally proved itself again. It's back to a free cash flow generative machine. I think many investors has been casting a lot of doubts on Alibaba as a business, on whether they can still produce free cash flow or whether they are strangled by the neck and strangled by competition. But evidently, $5 billion in USD per quarter, by the way, means that it's actually generating around 20 billion per annum. So let's make a bold assumption here. If Alibaba is going to plateau its business, meaning that it has zero growth from here on, but if it's able to hold a 20 billion USD free cash flow generation on a yearly basis, at current market cap, which is around $200 to $220 billion, it's trading at 10 times free cash flow. So 10 times free cash flow just means that within 10 years, they're able to generate enough free cash flow to buy back the entire business on itself, at today's valuation, of course. So just let that sink in a little. Now, looking at the segmented results, I think this is just a very broad overview. We will pay closer attention by referring to the Excel, because these numbers on a standalone basis, what does negative 1%, 4%, 21%, 36% mean? Nobody knows. It has to be a year-on-year comparison, and it has to be a multi-year comparison in order for you to have a better expectations of what is to come. So these numbers, I'll leave it as that. We will go into the individual segments first on a qualitative basis. So firstly, when we look at China commerce, this is basically the golden goose of Alibaba's business. It has been printing the most amount of margin. It's the most profitable. I think like Cloud and Cainiao, which is the logistics network, is probably adjusted EBITDA profitable. But like many of you know, I think Charlie Munger did call adjusted EBITDA, adjusted EBITDA, all those are all bullshit earnings. So this is still the most profitable business of Alibaba till date, and in the foreseeable future as well. So there's three specific parts to it: customer management revenue, direct sales, and China commerce wholesale. So looking at it, you can see that the customer management revenue has always been the biggest pie of the entire e-commerce business. And you can see that it's a negative 7% year on year. And the expectations, or at least the management is guiding that customer management revenue actually decreased by 7%, primarily due to the low single-digit decline of online physical goods GMV generated. And we have to, of course, cross-check this with the competitors. But I think judging from the industry standard, there is a significant slowdown, or at least an impairment in growth for many of these e-commerce businesses. So CMR was down 7%, while direct sales was up 6%. And this essentially negated the effect. That's why you can see that the China commerce revenue was only down negative 1%. Specifically, I think for direct sales, the core growth driver was actually contributed by Fresh Hippo, which is their groceries business, and Ali Health, which is their health business. So on the flip side, you can actually observe that EBITDA margins actually increase. So EBITDA, in this case, is earnings before interest, tax, and amortization. So it increased by 6%. So they did provide the reason that the increase was primarily due to the Taobao Deals and Taocaicai reduced losses. And evidently, the innovation here, or at least the penetration into the new markets, has been bringing down their core margins. Generally speaking, if you look at the China commerce business as a whole, there really isn't anything spectacular about it, but there's not much to complain about as well. because they are doing what management is guiding. Essentially, I'm saying that they are optimizing operating efficiency. It comes through in terms of optimizing margins as well. So that's probably why the market took it pretty well. I think for the international commerce, I really don't have a lot of comments on this because it has been disappointing quarters after disappointing quarters. Many people have been saying that, oh, this is the growth engine of Alibaba. Evidently, 3, 6, 4%, there's nothing happy about this sort of growth. And more specifically, at least in this side of the globe, Lazada's main competitor is actually Shopee, and Shopee, which is still limited, is also a listed entity. And if you to compare many of these discussions around Lazada versus Shopee and how their growth rate in terms of their e-commerce business, Lazada has been pretty lackluster. But on a similar note, they did reflect reduced losses from Lazada and Trendyol. So in this environment where everybody is tightening their belts, I guess this is rather manageable. Now, moving on to the local consumer service, I think this growth year on year actually surprised quite a lot of people on the upside. Similarly to Cainiao, which is the logistics business, a 21% year on year growth. Given the context that the rest of your business is deteriorating, I guess it's kind of a glimmer of a hope. But I think the bigger excitement here is that you can see there's actually a higher average order value and more efficient use of their subsidies, which is reflected quite evidently in terms of their improvement in margins. So they also did provide commentaries that Ele.me, for those of you who don't know, Ele.me is basically the Grab of China. It's experiencing improved unit economics per order, and there is also a strong order growth of AMAP business. So AMAP is basically the GMAPs of China. Alibaba is building their food delivery business on their own platform, so they kind of manage the whole ecosystem. So that's just some context. Now, moving on to Cainiao, this also surprised everyone to the upside, a 36% year-on-year increase. So I think the first question that popped up to my mind was, they stated that the primary contribution was the increase in revenue from domestic consumer logistics. But why is their commerce business seem to be collapsing? So where are all these orders coming from? And we have to triangulate this data with JD.com because JD actually has their own logistics capabilities as well. And that will provide a more wholesome picture. But I think for Cainiao, we are slowly looking at the capex paying off. So you can see that Cainiao is actually taking on more responsibility throughout the logistics process to better serve consumers and enhance consumer experience. So this is basically Amazon's playbook. They took out right out from Amazon's playbook where they heavily invest in their infrastructure, and which is why you can see that Amazon's free cash flow is basically non-existent and they plow in a lot of capex. But I think in today's context, Alibaba is pretty prudent in terms of their spending and their capex, which can be seen in the cash flow statement later. And given the idea of building out your own logistics capabilities and going deeper into the logistics chain, there was a decrease in margins and there was an increase in capex for the last few quarters. And it's kind of slowly paying off given this growth rate. So looking at cloud, it has been devastating. A 4% year-on-year growth, it's pretty lackluster. So many investors, myself included, we all have been pretty hopeful in terms of the cloud business expanding, and the total addressable market of China's cloud is pretty big, if you're going to ask me. So looking at the evolution of Ali Cloud's business, I think in 2019, they were growing at least 40 to 60% clips. And I think in 2021, 2022, they are growing in low single digits. And I think it's up to you to decide whether you think this is a short-term or a long-term problem. To me, I'm still in the short-term camp, considering the fact that I understand what China is currently experiencing thus far. So is this the bottom or not? I don't know, but based on the commentaries given by management team, I think they're hopeful moving into 2023. So they went on talking about the decline in revenue from customers in the internet industry, and many of them stopped using Alibaba's cloud service for its international business. So if I were to flip this commentary, it just means that people like ByteDance, Douyin, they are still using Ali Cloud solution for their local businesses in China. And for their foreign business, they're basically forced to use foreign solution. So to add fuel to the fire, they started blaming more people, saying that online education customers are also affected and there's a softening demand from other customers in China's internet industry. So this is not a very good reflection of management team because to me, as a shareholder, it seems like these are just excuses. But I think all else being said, I think I wouldn't really blame the management team for the lackluster growth in the cloud industry. And if I were to compare it to their counterparts, I think Tencent Cloud isn't having a very good time as well. For those of you who are interested, I'll be releasing a separate video on Tencent's earnings breakdown as well. So do feel free to check that out if you're interested. For digital media and innovation, I'm not very interested in this business. To me, I write it off as non-existent in my eyes as Alibaba shareholder. So I've come to the end of part 1 of Alibaba's recent earnings quarter breakdown. Just to provide some context and maybe give you some sort of a summary of what we have actually went through during the entire slide deck itself. So the biggest question is this the end of Alibaba? I think it's a little bit premature to conclude. We need a lot more data points. But given whatever that is happening in this previous quarter, some of the positives and negative takeaways from this specific report itself. A specific positive is definitely in terms of cost controls. You can see that it's reflected in the margins and reflected in the cost profile of the business itself. So they've been rather transparent in providing some sort of guidance and how investors are expected to think about the upcoming quarters. So the second positive is there are a few shining lights in whatever that's happening thus far. So for the local consumer services business and also the Cainiao business, which is their logistics business, I think for the growth rate was still well over 20%, more than 20% in fact. And this essentially got people excited. Is this the next growth engine? Is this the next growth engine? But I think for me specifically, this business itself, I will still put it in the KIV bucket. It's too early to conclude anything substantial because let's not forget, Alibaba still focus a lot on the China commerce business. And some of the negatives from this recent earnings quarter, the China headwind is still extremely prevalent. Headwind in terms of deterioration in terms of e-commerce consumption and also the cloud adoption. It has been abysmal, and I'm sad to say I'm actually quite disappointed as an Alibaba shareholder in terms of this cloud business. This is the next growth engine for Alibaba, so if they're not able to tap onto this cloud adoption, it will be a very big problem moving forward. And I think one of the most important questions many of all the Alibaba back holders out there have to ask yourself is, will growth ever recover? With that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye.